I'm here to discuss the financial statement and their interpretation. In this lecture, we have only one learning objectives, to be able to determine and explain the parts of financial statements. So let's start. So what is financial statement? Statements are written records that convey the business activities and the financial performance of a company. So in a financial statement, they have four parts: a balance sheet, an income statements, a cash flow statements, a statement of shareholders' equity. So first, what is a balance sheet? A balance sheet provides detailed information about a company's assets, liabilities, and shareholders' equity. So assets are things that a company owns that have value. Example, machinery, property, raw materials, and inventory, and intangible items like patents, royalties, and other intellectual properties. So assets have also three types: current assets, non-current assets, and fixed assets. Current assets are things a company expects to convert to cash within a 1 year. Non-current assets are things a company does not expect to convert cash within 1 year, or that would take longer than 1 year to sell. Non-current assets includes fixed assets. Fixed assets are those assets used to operate the business but that are not available for sale, such as trucks, office furniture, and other property. Liability Liabilities. Liabilities are amounts of money that company owes to others, so are generally listed based on their due dates. Liabilities also are said to be either current liabilities or long-term liabilities. Current liabilities are obligation a company expect to pay off within the year. The long-term liabilities are obligation due more than 1 year away. And the last, shareholders' equity, is sometimes called a capital or net worth. So here are the formula of a balance sheet. Assets is equal to liabilities plus shareholders' equity. So the second financial statement is income statements, a report that shows how much revenue a company earned over a specific time period. Earning per share or EPS. Most income statements include a calculation of earnings per share or EPS. This calculation tells you how much money shareholders would receive for each share of stock they own if the company distributed all of its net income or the period. To calculate the EPS, you take the total net income and divide it by the number of outstanding shares of the company. So the third financial statement are cash flow statements. Cash flow statements reports a company's inflows and outflows of cash. This is important because a company needs to have enough cash on hand to pay its expenses and purchase assets. A cash flow statement shows changes over time rather than absolute dollar amounts at a point in time. It uses and reorders the information from a company's balance sheets and income statement. Income statements can tell you whether a company made a profit. A cash flow statement can tell you whether the company generated cash. So there are three types of activities and cash flow statements: operating activities, investing activities, and financing activities. Operating activities, these statements analyze a company's cash flow from net income or losses. Investing companies, this statement shows the cash flow from all investing activities, which generally include purchases or sales of long-term assets such as property, plant, and equipment, as well as investment securities. Last, the financing activities. This statement shows the cash flow from all financing activities. Typical sources of cash flow includes cash raised by selling stocks and bonds or borrowing from banks. Likewise, paying back a bank loan would show up as a use of cash flow. And the last part of financial statement, a statement of shareholders' equity. This section of the balance sheet is also known as a statement of shareholders' equity or a statement of owner's equity. It gives shareholders, investors, or the company owner a picture of how the business is performing, net of all assets and liabilities. In simple terms, owner's equity is defined as the amount of money invested by the owner in the business minus any money taken out by the owner of the business. For example, if a real estate project is valued at $500,000 and the loan amount due is $400,000, the amount of owner's equity in this case is $100,000. And that's all. Thank you.